Have you ever wondered what actually happens on a company's books when they buy a massive multi-million-dollar piece of equipment? Because they definitely don't just wave a magic wand and make the cost disappear. Today, we're diving into this explainer to follow the fascinating life cycle of a major business purchase. We are going to completely master depreciation, taking you from the absolute basics all the way to those advanced accounting methods. So let's get right into it. Here is our game plan. We'll be hitting the concept, the main objectives, figuring out the true cost, component-based depreciation, the main methods you need to know, and then wrapping up with advanced methods and a solid recap. We've structured this to give you total conceptual clarity, and more importantly, to help you dodge those tricky exam traps that catch so many people off guard. All right, part one, the concept. Let's start with the fundamental problem that literally every growing business faces when they buy expensive new gear. So picture this. A business drops $10 million on a brand new factory machine. Why don't they just record a $10 million expense on day one? Well, if you expense a multi-million-dollar asset all at once, your year one profits are going to look absolutely terrible. Like the company is failing. Terrible. But more than that, it completely wrecks the core accounting matching principle. This is the rule that says you absolutely must pair the costs of an asset with the revenue it generates over time. I mean, if that machine is helping you make products for the next 10 years, it only makes sense that the cost should be spread over those 10 years, right? And that is exactly where depreciation swoops in to save the day. As per the Companies Act, depreciation is the systematic allocation of the depreciable amount of an asset over its useful life. It just systematically spreads that massive upfront cost across the periods the asset is actually helping us earn money. A really important thing to remember here. It's not about guessing the market value of the asset. It is strictly a process of allocating its original cost. Now, why do assets actually lose value in the real world? Sure, there's the obvious stuff, right? Normal wear and tear from running the machine day in and day out. But check out these secondary factors. An asset loses value even if it just sits in a warehouse doing absolutely nothing. That's due to the efflux, or basically the passage of time, or technological obsolescence. Just think about a brand new smartphone. Even if you leave it sealed in the box for 3 years, it's going to be worth a fraction of its original price just because newer, better tech has come out. Moving right along to part two, objectives. We really need to understand why accountants get so obsessed with calculating this perfectly. What's the end game here? If you're studying for an exam, you absolutely need this memory trick. The 4 main objectives are TRFC: true results, true position, replacement funds, and cost of production. Boom, TRFC. First, we need the true results of operations, meaning our profit or loss is actually accurate because we've accounted for the asset wearing out. Second, a true and fair view of our financial position, so we aren't lying to investors about what our assets are actually worth. Third, it helps accumulate funds for replacement. Since depreciation is an expense that doesn't actually require cash to leave your bank account, it effectively keeps cash inside the business, so you can buy a new machine when the old one finally dies. And finally, ascertaining the true cost of production. Because let's face it, the wear and tear on your machine is a very real cost of making your product. All right, part 3, determining the asset's cost. This right here is a massive, highly testable area. I mean, you can't depreciate something if you don't even know its correct starting value. Listen closely because this is a classic exam trap that trips up so many people. When you buy an asset, you include the purchase price, any non-refundable taxes, site preparation, installation, and even the money you spent testing it to make sure it actually works. But here's the catch. Things like inauguration parties, advertising your new product, staff training, and relocation costs, those are never added to the asset's cost. No exceptions. They are just regular day-to-day business expenses. Examiners love, and I mean love, to throw in staff training to trick you into inflating the asset's value. Seriously, don't fall for it. The golden rule to live by in asset accounting is incredibly straightforward. You only include expenses that are strictly necessary to get the asset ready in its intended location and in the exact condition intended by management. Once the machine is plugged in, powered up, and capable of operating, you stop adding to its cost. Any repairs or tweaks after that point, those are just regular old expenses. Okay, so you've nailed down the true, accurate cost. But hold on, you don't necessarily depreciate the whole thing. First, you have to estimate what you can sell it for at the very end of its useful life. We call this the residual or scrap value. You just take your historical cost, subtract whatever you expect to sell it for as scrap, and that leaves you with your actual depreciable amount. So if a machine costs $100,000 and you know you can sell it for $10,000 in scrap metal in 5 years, your depreciable amount is $90,000. That $90,000 is the number you're actually spreading over time. Which brings us to Part 4, component-based depreciation. This is required by accounting standards and the Companies Act. It sounds a bit advanced, but it honestly makes total sense once you think about it. We call this component accounting. Just think about a commercial airplane. You literally can't just depreciate an airplane as one giant single asset. The airframe, like the body of the plane itself, might easily last 20 years. But those massive multi-million-dollar engines, they might need to be completely replaced every 5 years. And the passenger interiors, the seats, the carpets, those get thrashed and might only last 3 years. Because these components have completely different useful lives and significant costs, you absolutely have to separate them out and depreciate them on their own unique schedules. Doing this makes your financial reporting infinitely more accurate. All right, Part 5, the main depreciation methods. Now that we know what to depreciate and we know exactly how to calculate the base amount, how do we actually do the math? We've got two major heavy hitters here. First up is the straight line method, or SLM. This gives you an equal, constant amount written off every single year. It's wonderfully simple, predictable, and it's absolutely perfect for assets that lose value at a steady pace, like office furniture. Then we have the reducing balance method. You might also hear it called the written down value, or WDV method. For this one, you apply a fixed percentage to the remaining book value. Because that book value shrinks every year, your depreciation expense starts out very high in the early years and gets much, much smaller later on. Now, you're probably thinking, why on earth would I use the reducing balance method and willingly crush my year one profits? Well, here is the absolute genius of it. It smooths out your total expenses over the asset's entire life. Think about buying a car. In the first couple of years, the depreciation is huge, but your repair costs are basically zero. But fast forward to year 8, the depreciation is tiny, but suddenly your repair bills are massive. The WDV method balances this out beautifully. It pairs high early depreciation with low repairs, and then later pairs low depreciation with high repairs. This keeps the total financial burden on your profit and loss statement remarkably stable. When it's finally time to record all this in the books, a lot of companies use a really smart trick. Instead of directly reducing the asset's value in the main account, they route the expense through a provision for depreciation or an accumulated depreciation account. So you debit your depreciation expense and you credit the provision account. Why do it this way? Because by crediting a separate account, businesses can clearly show the original gross cost of the asset right alongside the accumulated wear and tear on their balance sheets. It just makes everything incredibly transparent for anyone trying to read those financial statements. Final section, Part 6, Advanced Methods and Recap. Let's briefly look at some specialized cases where wear and tear isn't just about the clock ticking, and then we'll lock all these concepts in. Sometimes you're going to see a variation of the reducing balance method called the sum of years digits method. And there's a really cool math trick for this one. If you have a 10-year asset, you simply add up the digits of its life, 10 plus 9 plus 8, all the way down to 1. That equals 55. That number, 55, becomes the constant denominator for a fraction-based calculation. So in year 1, you depreciate 10 over 55 of the cost. Year 2 is 9 over 55, and so on. It gives you that accelerated front-heavy depreciation curve, but you don't even have to mess around with percentages. But what if your machine loses value based on how much it actually works, rather than just getting older? For that, we use the production units method. Let's say your machine is rated to produce exactly 1.5 million widgets over its entire lifetime. You just base your depreciation on how many widgets you actually churned out that specific year. So if you made 150,000 widgets this year, bam, you expense exactly 10% of the machine's depreciable amount. It is literally the ultimate real-world application of the matching principle. Okay, let's bring it all home. Seriously, take a mental picture of these revision notes. If you can just remember the TRFC objectives: true results, true position, replacement funds, and cost of production. And if you can spot those exam traps to strictly exclude marketing, training, and inaugurations from your asset cost. And finally, remember the component rule. For complex assets, plus the core difference between the steady SLM and the repair balancing WDV method, you are going to absolutely crush this topic. Before we wrap up this explainer, I want to leave you with a bit of a brain teaser. Imagine you buy high-tech equipment that physically lasts for 15 years, but you know for a fact it'll be totally obsolete in 3. Which useful life dictates your depreciation schedule? I'll leave you to ponder that vital difference between economic and physical life. Thanks for hanging out and exploring the journey of an asset with us. Keep reviewing those core concepts, and we'll catch you in the next one.
Hey everyone, and welcome to this explainer. Today, we are diving deep into the really fascinating life cycle of business assets. We're going to cover everything from natural resources pulled right out of the earth, all the way to invisible rights like software and patents. But look, we aren't just going to rattle off textbook definitions here. We're going to learn exactly how to master the advanced accounting rules you need for your exams. If you've ever felt totally tripped up by mid-year asset sales or, sudden changes in depreciation methods, you are absolutely in the right place. Because mastering these rules isn't just about passing a test, it's about understanding the true financial health of any massive business.
Okay, so here's our asset lifecycle breakdown for today. We'll be covering the depletion of natural resources, asset disposal and sale, changing estimates and methods, asset revaluation rules, and we'll wrap up with intangible assets and amortization.
All right, Phase 1, natural resources and depletion. Let's jump right in.
So we're starting with assets that get physically eaten up over time. Think of it kind of like drinking a finite milkshake. That brings us to depletion. Now, depletion applies specifically to wasting assets. We're talking about things like oil reserves, gas fields, timber forests, and mineral mines. Because unlike a piece of machinery that just gets older and rusts, a mine literally empties out. So how do we actually account for that? Well, it's a pretty simple formula. You just divide the total cost of the asset by the estimated total quantity available, and that gives you a depreciation rate per unit. Then your annual depletion is just that rate multiplied by whatever quantity you actually extracted that year. Simple, right?
Let's look at the math, because this perfectly illustrates how it works using illustration 6 from our source material. Imagine a business takes out a quarry lease for 1 crore rupees. The technical estimate says, okay, there are 2 lakh tons of minerals in there. So 1 crore divided by 2 lakh tons gives us a nice, neat rate of 50 rupees per ton. That means in 2019, when they pull out 2,000 tons, the depletion charge is just 2,000 times 50, which gives us 1 lakh rupees. Extract more the next year, you charge more. This is literally the matching principle in action, guys. It perfectly matches your expense to the exact physical consumption of the asset that actually generated your revenue for that year.
Moving right along to Phase 2, asset disposal and sale.
So, what exactly happens in the books when a machine finally dies or gets sold halfway through its life? You definitely don't just erase the asset from your balance sheet and call it a day. No way. You have to calculate the precise profit or loss on the exact date of that sale. And honestly, let me tell you, this is a major area where students lose marks in exams simply because they rush the timeline.
The crucial thing to remember here is this exact step-by-step sequence. Whenever any depreciable asset is sold during the year, depreciation absolutely must be charged on it for the period it was used in that specific sale year. The biggest exam trap by far is forgetting step 2. Just remember this little rule. Don't skip the dip. You always have to dip into your profits for that partial year depreciation first. Let's say you start the year on January 1st with a book value of 50 lakhs, and you sell the asset on July 1st. Well, you've used it for exactly 6 months, right? You must calculate and subtract that 6 months of depreciation to find your true written down value on July 1st. Only after you do that can you compare that number with your sale proceeds to find your profit or loss, which then goes to the profit and loss account. Bottom line, never, ever skip the partial year.
All right, let's head into Phase 3, changing estimates and methods. So what happens when management suddenly changes their mind about an asset's future? Because this happens all the time in the real world. According to accounting standards, you actually have to review your depreciation method, the useful life, and the residual value at least at each financial year end. If the expected pattern of those economic benefits changes, well, your method has to change too. But here's the golden rule you need to know. Any change in depreciation method is treated as a change in an accounting estimate. Think about it like recalculating your GPS when you hit bad traffic. You don't drive all the way back home and start the trip over, right? That would be crazy. You just adjust the remaining time and distance from exactly where you're currently sitting. In accounting, this means the change is applied prospectively. You do not restate the past. You simply apply the new rules to your remaining written down value over the revised remaining life.
Let's make this super concrete. In illustration 11 from our sources, an asset's remaining written down value is 4,20,000 rupees. The original remaining life was 7 years, but then management revises that estimate down to just 5 years. So what's the new depreciation? You just take that remaining book value of 4,20,000 and simply divide it by the new revised life of 5 years. That means your new annual depreciation becomes exactly 84,000 rupees moving forward. The past years, they're completely locked and totally ignored. It's just simple, forward-looking math.
Which brings us to Phase 4, asset revaluation rules.
Okay, so what if the market suddenly changes the fair value of our asset entirely? If a company chooses to, an asset whose fair value can be reliably measured can actually be carried at its revalued amount. But how we account for that depends entirely on whether the value went up or down. Here's a great memory trick for your exam. Surplus to the sky, P&L to die. If the revaluation is an increase, it goes straight to the sky. That means it totally bypasses the income statement and gets credited directly to owner's interests under the heading Revaluation Surplus. But if that revaluation is a decrease, it dies right there in the current year. It gets charged directly as an expense to the statement of profit and loss.
Now, what's really interesting here is the exception to that rule. What exactly happens if an asset bounces back? If you previously took a decrease and put it in the P&L, and now the asset's value suddenly goes back up, you don't go straight to surplus. You have to credit the P&L first to cancel out that previous hit. Only the excess amount goes to revaluation surplus. And it works the other way too. If an asset that previously created a surplus drops in value, you don't hit the P&L right away. Think of it as cleaning up your past mess first. You debit the revaluation surplus to wipe out that specific asset's past gains, and only the remaining loss hits the P&L. It's all about precisely reversing the steps you took before.
Finally, Phase 5, the invisible assets, or intangibles. So now we're moving away from physical machines and rock quarries to what I like to call the ghosts of the business world. By definition, an intangible asset is an identifiable, non-monetary asset without physical substance. You literally can't touch it. Identifiable just means you can separate it from the business and sell it on its own, and non-monetary means it isn't just a pile of cash sitting in a bank. We're talking about things like computer software, streaming rights, patents, and trademarks. And here's the thing. Even though you can't touch them, they are held for use in producing goods, renting to others, or for administrative stuff. So, just like physical, tangible assets get depreciated, these invisible assets have to systematically have their depreciable amount allocated over their useful life. We just use a slightly different word for it: amortization. The concept is identical, we're just applying it to invisible things.
For your exams, you absolutely have to remember these golden rules for intangibles. Number 1, because things like software suffer from rapid technological obsolescence, they get outdated fast, it's presumed that the useful life of an intangible asset will not exceed 10 years from the date it's available for use. The only exception is if you have hard evidence otherwise, like a legal contract for a longer period. Number 2, the residual value is assumed to be absolutely zero. I mean, who wants to buy 10-year-old software, right? The only rare exceptions to the zero residual value rule for your exam are if there's a legal commitment by a third party to buy it at the end of its life, or if an active market exists that will likely still be around at the end. And finally, just like physical assets, they are derecognized, completely removed from the balance sheet, on disposal, or when absolutely no future economic benefits are expected from them anymore.
Okay, let's wrap this all up with a masterclass recap and look at some of those sneaky exam traps.
We've covered a massive amount of ground today. I seriously recommend taking a screenshot of this slide right now. It literally contains the ultimate cheat codes and exam traps to make sure you get full marks on advanced asset questions. Just remember, for depletion, find your rate per unit based on the total estimated quantity. For disposal, the ultimate trap is the date. Always calculate that partial year depreciation before finding your profit or loss. For estimate changes, we look forward prospectively, we never look back. For revaluations, remember surplus to the sky, P&L to die, but always double-check if you need to reverse a previous move first. And for intangibles, your default should be a max 10-year life and a zero residual value.
I want to leave you with this final thought to really spark your curiosity. We've spent a lot of time today talking about machines, quarries, and physical properties. But think about it. In a world that is rapidly shifting to software, artificial intelligence, and digital rights, how long until intangible assets completely take over the balance sheet? Will the rules of amortization eventually become the only rules that matter? Thank you so much for joining me on this deep dive. Thanks for watching this explainer, and I will catch you in the next one.
Welcome to this explainer. Today, we're taking a really fascinating journey. We are going to trace the entire life cycle of an asset within a business. We're talking from the exact moment it's born and put to work, all the way to its retirement or disposal. But more importantly, we're going to master exactly how we account for this journey. Because let's be real, whether you're managing a family budget, running a startup, or sitting down for a major professional accounting exam, truly understanding the life of an asset is basically an absolute superpower. So let's get into it. Here is our agenda for today. We'll be looking at 1. Basics of asset depreciation, 2. How to calculate depreciation, 3. Revaluation and life changes, 4. Amortization of intangible assets, 5. Common exam traps, and finally, 6. Final recap and review. Section 1, Basics of Asset Depreciation.
Okay, right off the bat, the most crucial point is this. Depreciation is not about valuing an asset for a future sale. That is a massive, and I mean massive, misconception. Instead, it is the systematic allocation of the depreciable amount over its useful life. Think of it like a giant matching game. You're trying to match the initial cost of, say, a machine to the revenue that specific machine helps generate over time. If a delivery truck is out there delivering goods for 10 years, its original cost should be spread out over those exact 10 years of earnings. It just makes logical sense, right?
So why do we even bother doing this? Well, first, it ensures correct income measurement. You're matching this year's literal wear and tear against this year's profit. Second, it shows the true, honest financial position in our balance sheet. But the third point, this is the secret weapon, funds for replacement. By recording depreciation, we are essentially holding back profits from being distributed to owners. It's like building a silent savings fund. So when that old asset finally breaks down and dies, you already have the financial foundation to buy a new one. Now, let's clear up a major conceptual hurdle where a lot of people get stuck. Imagine paying your monthly rent versus buying a heavy-duty machine. Paying rent or buying daily inventory is a cash expenditure. Actual, physical money is leaving your bank account today. But depreciation, it's a non-cash expense. You literally already spent the money when you bought the machine 5 years ago. Now you're just allocating that past cost on paper. Understanding this non-cash nature is absolutely key to realizing how it helps accumulate that replacement fund we just talked about, all without draining your daily cash flow. Section 2, How to Calculate Depreciation. Okay, so there are two main ways to actually calculate this math. First up, this straight line method. This one is super straightforward. It gives you a flat, constant expense every single year. It's perfect for assets that wear out evenly, like maybe a basic office desk. Then you have the diminishing balance or written down value method. This one charges a constant percentage on a declining balance, which basically means it front loads the cost heavily in the early years. Why do that? Well, because some assets, like high-end tech or vehicles, lose a ton of value right out of the gate, while their repair costs naturally go way up later in life. This method balances that whole dynamic out perfectly. Now, examiners literally love testing what we call accelerated methods. So let's break down an exact exam scenario to make sure you've got this. Akash buys a machine for 12 lakhs. It has a scrap value of 1 lakh and a 10-year useful life. Using the sum of the year's digits method, you actually don't use a flat percentage rate. Instead, you take the sum of the years, so 10 plus 9 plus 8, all the way down to 1, which equals 55. For year 1, you take the highest digit, which is 10, divide it by that 55, and multiply it by the depreciable amount. The depreciable amount is just the cost minus scrap, so 11 lakhs. Do the math, and that gives us exactly 2 lakhs for the first year. I know it sounds a bit complex at first, but if you just practice and memorize that fraction trick, it is honestly easy marks on exam day. Section 3, Revaluation and Life Changes. Life happens, right? Things change. So let's dive into revaluation rules. If you suddenly realize your machine is going to last 8 years instead of the original 5, well, that's just a change in accounting estimate. You don't go back and rewrite the past. Instead, you apply the remaining depreciable amount over the revised remaining life. Also, here's a golden rule. If you revalue one piece of machinery, you must revalue that entire class of assets. You cannot cherry pick just to make your books look good. Finally, if the value drops, a downward revaluation, it must first eat into any existing revaluation reserve before it ever hits your profit and loss account as a straight-up loss. Okay, what about when an asset is sold, scrapped, or even completely destroyed? It's leaving the business, so you need to clear it from your books safely without messing everything up. Always follow these 3 exact steps. Step 1, calculate the depreciation right up to the exact date of the sale or the accident. Step 2, find your newly updated book value and compare it to whatever cash you received from the buyer or maybe the insurance company. Step 3, the difference between those two numbers is your final gain or loss, and that gets transferred straight over to the profit and loss account. Let's actually look at this disposal process in action with a company called LG Transport. So they bought a truck for 45 lakhs in April 2019. Fast forward to October 2021 and boom, total disaster, it's completely destroyed in an accident. The insurance company pays out 27 lakhs in full settlement. Now to find your true accounting loss, you cannot, and I mean cannot, just subtract 27 from 45. That's a rookie mistake. You have to calculate the depreciation for the full years of 2019, 2020, and the 9 months leading right up to October 1st, 2021. Only when you have that highly exact, updated book value can you compare it to the 27 lakhs to find your true loss. Precision is literally everything here. Section 4.
Amortization of intangible assets. So far, we've talked about physical things, but the crucial point is that things like patents, software, and highly researched battery technology don't have any physical substance. You literally can't touch them, but they are absolutely identifiable non-monetary assets that you hold to generate revenue. And just like a physical machine on a factory floor, their economic value wears out over time. Patents eventually expire, software becomes totally outdated.
Now, because they are invisible, we don't call it depreciation. For intangibles, we use the word amortization. Here is a great memory trick for your exams. Amortization starts with A, so think of air. You can't touch it. But remember, while the word is different, the core logic is exactly the same. It is the systematic allocation of the asset's depreciable amount over its useful life. The mechanics, the math, and the goals haven't changed one single bit, just the vocabulary. Section 5, Common Exam Traps. All right, pay close attention, because here is a classic exam trap that catches students off guard every single time. Imagine your business had a really terrible year. Profits are way down. The examiner asks you, can you just skip recording depreciation this year so your financial loss doesn't look quite as bad? The answer is a massive, capital letters, false. Never skip depreciation just because times are tough. Depreciation is a fundamental charge against profit. It's an objective measurement of how much of that asset you consumed, not an appropriation of profit that you can just decide to dish out later if you feel like it. By law and accounting standards, it absolutely must be provided for, period. Even if it makes your financial loss look way worse, truth and accuracy in accounting always come first. Okay, here is another really tricky scenario for you. What exactly counts as the true cost of your property, plant, or equipment? If you buy a massive new machine and then throw an amazing inauguration party to celebrate opening the new factory line, can you add the DJ and the catering costs to the value of the machine on your official balance sheet? The answer is false. Accounting very strictly defines cost, which means you must completely strip away the party expenses. The true cost of an asset only includes the purchase price, non-refundable taxes, import duties, and costs directly attributable to getting that asset ready for its intended use. Inauguration costs do not make the machine run any better or faster. They are just regular expenses, and they go straight to the profit and loss statement for that year. Let's look at one final, very sneaky true or false question. The examiner asks, while calculating depreciation, does the straight line method give more depreciation on land than the written down value method? Take a second to really think about your formulas here. Well, it's a complete trick. The answer isn't about which calculation method is higher or lower. The answer is false entirely, because land has an indefinite useful life. You never depreciate land. In fact, as we all know, land usually appreciates in value over time. So do not fall for the examiner trying to make you calculate complex math on an asset that shouldn't even be touched in the first place. Section 6, Final Recap and Review. Let's lock in our final revision points right now so this is cemented in your mind forever. Remember, depreciation is a non-cash expense used to allocate past cost. It's not trying to value an asset for a future sale. For your calculations, use the straight line method for even, predictable wear, and the diminishing balance method for front-loaded costs. If you ever face a disposal or a sudden accident, always calculate depreciation up to the exact date of the event before finding your true gain or loss. For invisible assets like patents or software, rely on our memory trick. A is for air, amortization, and never ever skip depreciation during a loss year. It is a mandatory charge against your profit. Ultimately, these aren't just arbitrary textbook rules. By holding back distributable profits, depreciation builds a silent, highly effective replacement fund. So, I want to leave you with this provocative thought. Look at your own numbers. Are the accounting policies you apply today truly preparing your business to afford the replacements of tomorrow? Thank you for exploring the complete journey of an asset with me. Keep these fundamental principles in mind, keep an eye out for those sneaky exam traps, and you'll master this life cycle perfectly.